All right, good afternoon. My name is Ala McCoy. I am Director of Startup Support at the University of Maryland's Ventures. And I'd like to extend a very warm welcome to all of you who joined us today for the next installment in Startup Fundamentals Workshop Series. This series is offered by Ventures with collaboration from Maryland Technology Enterprise Institute and the Ingman Center for Entrepreneurship at the University of Maryland. To everyone attending the live session, please feel free to submit questions using the Q&A function at the bottom of your screen. At the end of the session, if you would like to answer your question via audio, you can also raise your hand and I can unmute your mic. We are recording this session. It will be posted on our Startup UMD YouTube channel. So if you wish to remain anonymous, you can do so by submitting your question via the Q&A function and selecting that you would like to be listed as anonymous. So startup founders very often focus a lot on how to prepare for the pitch and how to impress venture capitalists and angel investors. And actually, we have a workshop scheduled on this topic on Monday at noon, led by Glenn Hillman. So highly encourage all of you to join that workshop as well. However, what happens when your pitch is fantastic, you've done everything you need to do, and the venture capitalist is interested and wants to talk to you? What happens then? So that's what we'll be discussing today with Mike Ravenscroft. Mike is a seasoned venture capitalist, Smith School MBA graduate, so he's a TERP. And Mike is also managing the Momentum Fund. It's a venture investment fund run by the University System of Maryland. So Mike, thank you so much for spending your time with us. I know you do this every day. This is what your job is. And this is sort of, there's a lot of sessions on how to pitch, but this part is sort of shrouded in a cloud of, we don't know what happens. So thank you for spending your time with us and telling us what happens next.
Of course. No, happy to do it. Thank you so much for the time. I think you might need to enable sharing so I can share my screen. But while you're doing that, I'll just sort of say, good afternoon, everybody. Really appreciate you guys taking the time. It's very nice to see you all. Like I said at the top, please feel free to ask questions throughout. I tend to speak really quickly. If I keep going and there's a question, just interrupt me and I'll stop.
Okay.
But I really do appreciate the opportunity to do this because this is, as you said, a very important part of closing an investment. It is a critical function that every entrepreneur has to perform well in order to get a VC to invest. And it is not an easy process to get through. So it's actually quite easy to practice for a pitch. You can prepare that. You can do practice pitches. You can work through to get sort of a standard model. But diligence tends to be non-standard. It tends to vary from fund to fund. And so it really does help to have a game plan going in. It helps to understand roughly how the process works. This is something that you'll get better at the more you do it. But the more you can sort of avoid like common pitfalls that I'll sort of talk about later today, the better your chances will be at building a good relationship with your investor and ideally closing an investment. So today we're going to talk about why investors perform due diligence. I'm a first principles kind of person. I like to start at the foundation. Why do we do this? We're going to review what a due diligence process looks like, and we'll talk about sort of what a standard process might look like. We're going to discuss the components of a diligence checklist and what should be in your data room. And then I'm going to share some strategies for success, a lot of which are based on things that I've seen founders do that did not work well. And then some companies that I've worked with that taught me a lot about what a good diligence process should look like, and discuss what you can do to at least prime yourself and prepare yourself for success. I'm happy to take questions as we go. Please don't wait till the end. Please interrupt me if something I said doesn't make sense. If you would like to offer a counterpoint, happy to do so. Okay, so as Ala mentioned, I've worked for a couple different venture funds throughout the course of my career for about the last 8 years. I've been in VC in one way or another. I've run accelerator programs where I got entrepreneurs prepped to do diligence cycles. I've worked for seed stage venture funds. I've worked for a growth fund, and I've worked for Dream Ventures, where we did a lot of hands-on work with founders, helping them get their pitches and presentations to investors in order. And what I do now is run the Maryland Momentum Fund, which, as Ala said, is the University System of Maryland seed stage venture capital fund. So I'm going to give you guys a sense for what our diligence process looks like, just so that you understand what like a real fund's diligence process looks like. We're a bit of an interesting fund because we're a generalist fund. We do therapeutics, we do software, we do clean tech. It's very hard to do diligence across all those areas. And I will explain to you how we have figured out a way to do that. It's not the only way that we could do it, but it's a way that works for us. And ultimately, that's what you are doing when you work with a venture fund. You're going to be working with a process that they have developed over time that works well for them, and that is going to vary from investor to investor. Starting at the bottom, starting at the beginning, why do venture capital investors perform due diligence? So here's the standard answer. The standard answer is we do it to understand a company's core value proposition. We want to understand the customer pain points that you're solving for. We want to understand your customer base, really get a sense for how bad their lives are and how much better they're going to be once they have your solution in their hands. We really want to understand your differentiation. So the product, the core technology, what makes the team different from the next team that might be trying to solve the same problem. We also want to evaluate your intellectual property. We want to really look under the hood and understand what is it that makes up the technology you've developed, whether that's software, hardware, etc. We also want to understand fully the market potential for the product or the technology, right? Like the numbers that a founder shows you on a pitch deck about the market size, those are usually pretty big. We try to really get under the hood and understand, okay, if this is the customer and this is what they're paying for it, what is the actual market opportunity now and going forward into the future? Are there any headwinds or tailwinds that might make this harder or easier? We also want to make sure there are no major issues. Capitalization structure, board of directors, investor agreements, whether the company has any debts, whether there are any IP issues. We want to understand what the challenges are and whether we can get comfortable with them. You know, one thing that, and you probably not hear many investors say this, but there's no such thing as a perfect company. There's no such thing as a squeaky clean backstory, whether that's founders, IP, technology, status, market opportunity. There's always something wrong. The question is whether we can get comfortable with it. So if that's a cap table that's totally out of whack and needs to be fixed, can we get comfortable with that? If it's that there's an early investor that's trying to force a sale, is that something we can get comfortable with, right? We want to understand what the issues are to see if we can get comfortable with them. So that's sort of the standard answer for why VCs do due diligence. Here's the non-standard answer, and the real truth, in my opinion. We want to engage in a protracted trust exercise. Now, that may sound strange, but contrary to popular belief, we VCs are not risk-thirsty, crazy people. We actually are very risk-averse. We look for things that are sure bets. We try to eliminate as much risk as possible from the equation. We can't possibly have anything going into the deal that we didn't know about before signing the deal docs. Anything we do, even if it's a big bet, like a big swing for the fences kind of a play, that has to be based on and grounded in a thorough analysis of the company and the market opportunity. Full stop. There are maybe some funds that don't do diligence. They are the outlier. Most funds that I have worked with, in fact, almost all of them, they take a really hard look at everything before they make a decision. So the pitch, as Alice said, is a very sort of early part of the process. So Don, I see your question about debt load. I'm happy to explain that at the end. So just remind me, come back to it when we get to the end. So the pitch is a really early part of the process. It's also a very small part of the investment decision. So it's the first part, but it is by no means the majority of the decision. How many of you all, I can't see your faces, so feel free to just nod in the background, but if you've read the book Thinking Fast and Slow by Dan Kahneman, this is one of like foundational books in behavioral economics and certainly in economics of the sort of 20th century. But Daniel Kahneman talks about system one and system two thinking. So system one thinking is sort of instinctive, it's immediate, it's sort of your gut telling you to make decisions one way or another. System two is more rational, it's reasoned, and it's slower. And so I like to think about the investor pitch as system one. So you make a good impression, you make everybody think that what you're doing is interesting, you have convinced somebody that you are a legitimate entrepreneur who should be taken seriously and that you are on to solving a very big problem for a whole lot of people and you've got the only solution that anybody would ever want to use, right? That's system one. And so if you've done that already and you're in the diligence process, that's great. That is a great job. It's hard to do that. Most companies don't make it into a formal diligence process. System one matters a lot. The due diligence process is system two. This is when VCs slow down, they put entrepreneurs through their paces, and they really try to reckon with whether their system one thinking was accurate. So this is not the only way you can think about this. This is the way I think about this, just because it's easy to sort of make a decision fast and then think that it's the right one. But due diligence is a chance to slow everything down and truly evaluate. And I'll mention that Glenn is going to be doing a session on this next week. Glenn Hellman is one of my all-time favorite entrepreneurial coaches. He's very, very sharp. He's built many successful businesses. But he told me years ago, like 7 or 8 years ago, this was one of the first conversations I had with anybody in venture capital. But he said, people decide with their guts and they justify with their brains, right? You make a decision as to whether or not you like an opportunity as an investor based on a gut feel, but then you justify that with your like prefrontal cortex. And that is where you actually make the decision to sign the check. And in case this isn't clear, you, the entrepreneur, and your team, you guys are a key diligence item. So investors do diligence on companies all the time, and they know that this puts founders in a really high pressure, demanding situation. So I see a couple things in chat. Okay. This is a very intense situation, and these situations are challenging for entrepreneurs, so VCs know that. VCs also know that these situations are really common, right? Being a founder is not easy. You are always going to be in high-pressure, demanding situations. So performance under duress is something that we tend to screen for. We want founders who will not rattle. We want founders who understand that an ask might come in that is above and beyond. They understand they might have to negotiate or deal with challenging customers, might have to deal with challenging team members. All of that is a strength if you do it well. And that strength is something that we screen for. And whether investors understand this sort of, or not, I've done a lot of due diligence on lots of companies, so I kind of get this by now. But how a founder comports him or herself during a diligence cycle is a really good indication of how he or she will run a company. We want to invest in people that we know we can work with, that we'll work well with, that we can trust, and who will trust us. So this is what I mean by this being a protracted trust exercise. There's a lot of trust that goes into building any relationship. If you're taking investment from a VC at the seed stage, you are going to be in a relationship for at minimum 6 years. If the company goes out of business before then, it's a little less time. But if there's success, it's 6 to 10 years that you'll be working together. It's a whole lot of quarterly board meetings. The diligence process is the first chance we actually get to interact and engage with you outside of the pitch. So in some ways, this is the first real chance we get to engage with you, because the pitch is a lot of sort of theatrical stuff. I mean, this is something you've practiced, you've rehearsed, right? You're going off script here. So this is why VCs really do care about how founders act throughout a diligence cycle. So your attitude and your manner of engagement throughout the diligence process is as important as any document you're going to have in your data room, and it's certainly far more important than how you comport yourself in the pitch. So it's hard to do this because diligence can feel invasive. You are opening up your company's secrets. You're showing somebody from the outside everything that you've built, everything that you've got. There is a risk there. My suggestion to founders is always to enter into this with a productive mindset. So consider this the first phase in a long relationship. This is an opportunity to share information and insights about your business. It is an opportunity to be honest, open, and transparent with what you hope is going to be your future investor. Frankly, it's also a chance for you to understand your investor's motivations. You can also, depending on how much interest you have, ideally you have more than one investor who's interested in your company. But this is a chance for you to get to know your investor too. If your investor is sending you emails at 1, 2, 3 o'clock in the morning, demanding documents and saying, I need this by 9 a.m. I need this by whenever you can get it to me. That's a pretty good indication of how he or she will work like after they've invested in you. If they start to do customer calls that are, like lengthy, time consuming, your customers start calling you saying, I'm not sure this person really understands what it is you're doing. That should be a bit of a red flag for you. So again, this doesn't have to be a one-way street. It often feels that way, but this is a chance for you to understand the motivations of your investor, their understanding and their awareness of the business, and frankly, just to build a relationship from both sides. So let's talk about a due diligence process and what that might look like and what that might involve. So I said this at the top. These really do vary from fund to fund, and they can vary from fund manager to investor to principal to associate. So the variances are going to be down to the person. Most funds have sort of a basic structure for how they do due diligence, but oftentimes it kind of comes down to the person. So that's just something you kind of have to accept going in. The main variances that give entrepreneurs headaches are the cycle length and then the level of scrutiny. So some funds perform much more intense due diligence on the technology. Some do much more intense due diligence on the team. They might do multiple background checks for all of the team members versus a couple of reference checks for the CEO. But also the length of the cycle. And I'll talk about that more in a minute, but there is a standard sort of industry accepted general timeline, but it can really last as long as you're willing to let it last. Because the VC is not generally under a huge amount of time pressure. They can afford to wait. They're not running out of money. It's their decision when they invest. So there really is a bit of a power imbalance there. It's not great, but it's the reality. Investors who are leading around, they will typically offer a term sheet before going into sort of formal diligence. And by that, I mean seeing your data room. But not always. This really can vary as well. Also, if I'm not a lead investor, let's say I'm only a co-investor, I write smaller checks, maybe I'm an angel, I might just use the diligence of the lead investor. So I might ask for your lead investor's due diligence packet. I might reach out to the lead investor and ask to see that due diligence. And sometimes this can be a really good thing for a founder because that means you don't have to do multiple rounds of, say, customer calls or reference checks for your team. If one investor can do all of that, some co-investors will be perfectly comfortable following on that due diligence. So when I talk about diligence cycles, the reason these can vary is sometimes it varies. Sometimes it is the case that an investor doesn't enter formal diligence until they open the data room or until they do a term sheet. There could be sort of a protracted period of multiple rounds of screening calls, maybe a deep dive, a demo, before the VC thinks they've actually entered into formal due diligence. But on sort of the low end, if you think about like just the normal distribution, 45 to 60 days is pretty reasonable in my opinion. Any less than that, they're probably not doing a ton of diligence. And again, if they're a co-investor, maybe they don't want to, maybe they're not set up to do a ton of diligence, so it might take less time. More than 60 days, I've seen that. It's usually for like Series A and larger rounds. And it's usually when the market is really, really slow. You can just sort of afford to wait. You can wait for the next product release. You can sort of just take your time doing customer calls, doing market research, etc. So the general process, like I said, you got a couple screening calls with an investor. I would not be surprised if you do like 3, 4, 5 calls until you get a data room request. And if you're a software company, this could be like, actually going into like a formal demo, like a deep dive. If you're a hardware company, it might involve like actually looking at the product, going out, seeing the manufacturing facility, all that stuff. The investor will request access to your data room. Whenever I put out a data room request, it is because I am ready for the formal process to begin. So again, this kind of comes down to the person or to the fund, but generally speaking, if you're getting request access to a data room, it's not exactly starting a timer, but it does mean that things are happening, and you can expect to get into a process after that point. Generally speaking, a couple of follow-up meetings, usually 2 to 3. I will frequently do Zooms just to walk through what's in the data room. I'll sometimes do a Zoom following up after the first review of the data room to ask questions about things that are in the data room, things that I might need added, etc. Regardless, there's going to be many emails back and forth. So, and some of these get frustrating where it's sort of like a 1-sentence email. Why is net income from 2018 not match on the income statement, not match retained earnings from whatever? Like sort of 1-line questions. Those can get frustrating. They can be challenging. The reality is a lot of investors will just sort of fire off emails as they're going through the data room as they have questions. But that's just part of the process. And it comes down to the investor you're working with. Some investors, frankly, are more organized in this respect than others, and some have a more formal process than others. And if that all goes well, then you get to close. That's the end. So because diligence is a laborious and time-consuming process, most of us don't enter into formal diligence unless we're really interested. So the fact that you're getting asked for the data room really does mean the investor is interested. Most investors don't poke around in data rooms just for the the good of their health. Like I said, some will do this before a term sheet. Some will only do it after a term sheet. Given this market and how slow this market is, I would expect to do a full diligence cycle prior to getting a term sheet, or at least being in diligence for a while before getting a term sheet. Again, it's going to vary on the investor, but that's generally what I'm seeing anyway at this point. So here's what our diligence process looks like. So we do 2 to 3 screening calls with myself. I will always do a demo or a deep dive. So if it's a software product, I'll do a demo. If it's hardware, I will ideally go and see the hardware, go to the the company's offices, or at the very least just do some kind of deconstructed analysis of how the thing is built. Basically so that I know that there's a there and that I'm interested enough to want to do the next step of the process, which is an expert panel. So as I mentioned, we're a sector agnostic fund. So I will look at therapeutics on the same day as I look at a hardware company, as the same day as a medical device company. Those are all radically different products. They're radically different markets. And I am not a radical expert in all of those areas. I'm not even an expert in any one of those areas. I know enough to know when something's interesting. And I also have, and through the Momentum Fund, we have a fantastic network of folks who know way more about this stuff than I do. And so what we do is we bring them in to help us evaluate the opportunity. A lot of funds do this. They will have experts, maybe they'll have customers. I used to work for a cybersecurity venture fund. They had 70 or 80 chief information security officers that they would just reach out to, every now and then they'd reach 1 or 2. They'd say, hey, we're looking at a company that does this. Would you do a call with the company to sort of help us understand the opportunity? Or will you at least take a look at their pitch deck, take a look at the value proposition, let me know if this is something that would interest you? This is pretty common because most VCs are not true industry experts at the customer level. That's very hard to be an expert at the customer level. So that's why we have these networks that we call on to bring in to help us answer tough questions. And then frankly, to ask tough questions that we probably don't know that we need to ask. So for a Momentum Fund, if I'm evaluating, say, a seed stage software company, I will bring in a couple of investors who have done software startup investments. I will bring in somebody who understands software product, ideally from the industry, maybe from the same market, not a competitor, but the same market, understands the space, understands the customer base. And then ideally, I'll bring in a customer. I'll bring in a potential buyer of the solution. That expert panel, here's the company pitch. After that, the expert panel gives me feedback. They tell me what I need to look for in diligence. They tell me what the risks are. They tell me whether there's a real market opportunity from their perspective. I take that information and then I decide, is there enough here that I can move the company forward? So if I move a company forward, they present to my advisory board. My advisory board gives sort of a thumbs up or a thumbs down. All of our board members are on our website, so it's actually a fairly transparent process, which makes sense because we're a state entity, we're a state vehicle. And if that goes well, then the company's done presenting. I take the company and I present, or I take the, basically my write-up, my argument for why we should invest, and I take that to my executive committee, which is effectively my investment committee, and they make the decision about whether or not and how much to invest. So that's our process. It's formed over a number of years. We did some things wrong before we did everything right. We're not doing everything right, but it's gotten to the point where it works well enough for us and it works well for the companies. It's not too onerous on the companies, but it certainly gets us all the information we think we need to de-risk the investment and to be able to move forward. Like I said, a lot of funds will do this sort of expert panel portion. A lot of funds will call experts to do either calls with the founder or to just at least evaluate the technology. Most funds will do sort of a partner presentation, and then every fund has an investment committee that every investment has to be presented to. And then throughout all of this, it depends on when the data room gets opened. So for me, I try to do the data room as I'm going, and certainly before the executive committee. So I try to make sure that there are no major issues prior to getting to the executive committee. The simple reason being that if I know very early on that the CEO has 2% common stock, and one investor who has walked away from the company has 75% of the company, that there's going to be a challenge for us to invest. So that's a situation that's very hard to fix, and could be that there is not enough there that I can move it forward. So it helps to get all the sort of red flags out of the way to start. Okay, I think we're tracking okay on time. I don't see any questions in the chat, so I'm going to keep going. Diligence list. So this is where your data room comes in. So you guys are probably all familiar with this, so apologize if this is redundant, but this is your standard repository for any corporate documentation that is going to be relevant in your venture capital fundraise. This is basically all the information that is relevant to the company's business. And there are a lot of different parts of a company's business. There's lots of different parts of a company. So this will naturally include lots of different pieces and artifacts, pieces of information, artifacts that will be relevant and that will be requested as part of the diligence process. This is to be fully assembled before you start your fundraise. Very important to do that. It's also not a static thing. So whenever an investor asks for something new, something you didn't expect would need to be in the data room, I would add it to the data room, because chances are you'll get asked for it again. So this is basically something that keeps growing. You keep adding to it, and you certainly keep it updated. Because there's nothing worse than a data room that hasn't been touched in 9 months. All that's going to do is require you to do a whole lot of catch up and require your investor to do a whole lot of waiting while you get caught up. Now, before you build your data room or before you send your data room to an investor, I would ask yourself this question. There's no way they'd ask for this, is there? There's no way they'd want the conversion documents, right? There's no way they'd want resumes for all of my employees. There's no way they'd need consulting agreements going back to the beginning of the company, right? The answer is yes. There's always going to be an investor who asks for something that you did not think you would need to provide. So it definitely will benefit you if you include more than you think is necessary. There's really no downside to providing more information than is necessary. And I'll sort of explain a little bit more why in a minute, but there should not be anything secret here. So all of the information that you're going to be requested to give, you will have to give. The more that is there to start, as long as it's well organized, the better your investor will feel about you being transparent about what the company is doing, what your customers think of you, how well the product build is going, and what the financial projections look like. So again, trust exercise, right? The more that's there to start, the more transparent it looks like you're being. You want to put these in folders. This might sound silly, but you really do want this to be organized. You do not want to have to make somebody search for something. It should be in an obvious place. And there are ways you can organize this. There are lots of online resources as best way to organize a data room. A lot of law firms have published sort of, explainers on how to build a data room. Some law firms will build data rooms for you. I think there's a lot better way you could spend $15,000, which is probably what your law firm will charge if they're getting all these documents together and putting them all in and being responsible for sending those to investors. That gets expensive really fast. So I would do this yourself. You're perfectly capable of doing it. If you want to delegate somebody like an admin or your COO to do this, great. If you are big enough that you have an investor relations person, even better, but you're probably not. It's probably you, which is fine. This is all stuff that the CEO can do. And the CEO is going to be the point person on the diligence process. Why? Because the investor is developing a relationship with the CEO. The investor is not developing a relationship with your law firm. So if your lawyer is the one who's fulfilling diligence requests, like I said at the beginning, this is the first step to getting to know you as a company. I don't want to be outsourced. If I'm going to be an investor to you, I'm going to be on board calls with you. I'm going to expect to be able to call you and have you pick up the phone if I have a question, not in the middle of the night, but you do have to reckon with the fact that this is a relationship you're developing. This is not a loan that you're getting from a bank. So that's why the CEO being involved throughout this process really does matter. This might go without saying, but I have had companies just email me lots of really sensitive documents. Use an encrypted, secure, privileged access folder, which you can track as far as like time opened, folders opened, documents downloaded. You want that audit trail. You really, really do. If only because you want to make sure that nobody outside of who you think is accessing the folders is accessing the folders. It also makes it easier. It makes it way easier to just upload documents and send a file path. So if I say, hey, where's the balance sheet from 2020? You can say, just uploaded it. It's right here in this file path. What you can also do, if you really want to be professional about this, and I encourage you to, because it really does, again, make a good impression, I would create a diligence spreadsheet. I would have a spreadsheet that shows all of the key company documents, where the file path is located, where the document's located, what the file path is, and then maybe like a last updated date. You can put that in an easy Excel. You can have that in your data room. That makes it a lot easier than for an investor to have to email you and say, hey, I know I saw the cap table in here, but where is it? Right? You can give them something to point to. Again, the more professional your data room looks, the more time you spent making it look professional, the better that will reflect on you as a CEO. Again, people want to invest in people who are easy to work with, organized, who understand where their important documents are. This is all very important stuff. It's critical to the company. It should be very well organized, and it should be easy to access. And I already said this, but don't email documents. Recipe for disaster. All right. So what goes in your data room? So I'm just going to punch through this because this is all stuff that you have somewhere. It's just a matter of getting it together, updating it, and putting it into one place. So all of your company documents. So this is founding documents, charter, incorporation, any amendments to the founding charter, right? So this could be if you did financing, you amended the stock, the initial stock purchase agreement, right? Anything like that, that goes in here. Same thing for conversion documents. If you were an LLC and you are now raising money as a C Corp, conversion documents are in there. Board of directors, full list of board of directors, board seats, history of the board of directors, anything related to the board of directors if you have one. And by that I mean like if you have more than one person on your board, more than the co-founders on board. An organizational chart, ideally an organizational chart for now and then for post fundraise. If you have any open positions, identify those as open positions. Certificates of good standing. So you'll obviously have one for Delaware or wherever you're incorporated, but also the state in which you are headquartered and which you are operating. Financials, historical financials. This is probably the first thing most VCs look at, certainly the first thing I look at. You want these from inception until the current quarter. And if your diligence cycle bleeds from one quarter into another, which happens all the time, upload the most recent quarter. You're going to get asked for it. Just make sure it's there. Johnny on the spot. Same thing goes for tax returns. Tax returns from the inception of the company. If you have a pro forma, so if you have a lead investor who's sort of set the terms of the round and you have a pro forma cap table for the post financing, include that. And then make sure that everything is updated and make sure that everything is synchronized. So I can't tell you how many times I've looked at balance sheets, income statements, and cash flow statements and seen that there are just inconsistencies one to the other, right? Pay your accountants, pay them well, make sure that everything ties, and make sure there are no issues from one to the other. It's very common for balance sheets or for financial statements to get updated. Just make sure that they are updated properly and appropriately. Revenue model, very, very important. Every VC wants to know how you're going to make money and when. So ideally, projections 3 to 5 years out. 5 years gets a bit fanciful, but we're really looking for the ramp up and what that ramp up looks like. Ideally, and again, this can cost money. Most folks, I certainly couldn't build a complicated financial model. It is not my strong suit. I would hire somebody to do it for me. But what you want are switches that show your assumptions. So this really does differentiate sort of a JV from a varsity company where it's like, okay, this model is built on these assumptions. This is like 100 customers in the first year paying this much with this kind of adoption curve. And a switch to show, okay, what does the base bull bear scenario look like? What is good, what is bad, what is ugly? Investors are going to do that anyway. If you build that for them, then you get to, in some ways, control the narrative, but you also get to save them time. And they might ask you to build this. I've had investors say, your model doesn't make any sense. Like I've been invested in companies, and the founders have told me that, a lead investor said, our model doesn't make any sense. They want a new model. So it's like, great, you got to go build a whole new model or update your entire model in a couple days before they get impatient and start to wonder if there's something wrong. So the more work you do on this in the front end, the less you'll have to do in the back end, and that will make your life a lot easier if you have to update it or maybe model it to show something else. So definitely put some thought and time into your revenue model. Don't be afraid to use a consultant to do this. That's why financial consultants exist. That's why fractional CFOs exist. Definitely put some time and effort into this because it really does matter. If all you're showing in your revenue model is the slide that's on your pitch deck that shows, well, this year we lose money, but next year it's 100 million, and then 3 years out we're public, right? That just doesn't cut it. It won't survive a full diligence cycle, and it's the kind of thing that'll get picked apart. Worst case scenario, you have to build it on the fly, right? Or best case scenario, you have to build on the fly. Worst case scenario, the VC walks away because they don't think you've put enough thought into it. Capitalization. This one's pretty straightforward, but you want a cap table that shows all outstanding notes and convertibles. So, existing ownership, any debt you have, convertible debt, and any safes outstanding. Also want to have all the vesting schedules laid out. So what are your current vesting schedules? How much are employees vested? What is fully vested? Also, any equity awards or option agreements that you have with anybody on the team, including your advisors. You want to have, if you've done a prior round, or if you've taken money on the current round, signed investment documents from all investors. So this is something that, frankly, is hardly ever in a data room, and I always have to ask for it. But this is information that current investors are entitled to see. I want to know who's in, how much they've invested, and I want to confirm because it's a very important part of the company's capitalization. And frankly, I will also want to know let's just take a safe round, say, if you're raising on a safe, you can technically have different terms in different safes. So they have to be substantially the same, but you could give one investor a most favored nation and give another investor not a most favored nation. I'm the kind of investor, and I think I speak for most investors when I say this, I want the same terms as everybody else is getting. I think it's fair. And I think that, frankly, if you're not disclosing that other investors get better terms or preferential terms, maybe because they asked for it, but others didn't, that can be problematic. It can kind of sow discord among your investors if I find out after the fact that I'm in on a different valuation as another investor, even if it's the same round. So that can be problematic. And because of that, investors will ask for all this documentation. We will look at everybody who's ever put money into a company, and we will look at the documents and make sure that all the terms are the same, certainly on the current round, but then also understand what the investment history has been and how many investors do you have, how often have they invested, multiple times, once, etc. I might also want to talk to your existing investors. That's not at all uncommon. So get a sense for what's going well with the company, basically doing a diligence call with your existing investors. So it's a good idea to prepare all your investors for this. It's also a very good idea to tell your investors that you're raising capital. Believe me, I've had companies send me documents the day they want to close for a financing round I did not know was open. It's a great way to annoy your early investors. Don't do it. Prepare them for it, and prepare them for the fact that they might get contacted by a current investor who's doing diligence. So as far as the team goes, organizational chart, team bios, resumes, much as you've got. Chances are somebody will ask for it. I don't need to see resumes of everybody on your team. I know investors that absolutely want to see resumes for everybody on the team, including consultants. Employment agreements, vesting schedules, stock options allocations, and what the stock options plan is as well. If you have any 1099s, what are those agreements? And that goes to rate, number of 1099s, et cetera. Hiring plan post fundraise. So use of funds, what are you going to use the funds on? Mostly it's going to be to hire people. So your hiring plan you can include in your team folder. NDAs and disclosures for all team members. So all of your team members should be under a sort of standard IP disclosure and likely a standard NDA. Want to see those, make sure they're all signed. Intellectual property. This one's pretty straightforward. Full list of patents, copyrights, trademarks, everything you've got that's either pending, in process, been awarded, all of that is there. Increasingly, and this is for companies that actually know how to diligence software company, or excuse me, for venture funds that know how to diligence software companies, you want to show all the sort of, that's like the bill of goods basically, but like whatever software you've used to build your software, investors need to know what the rights are. If you have usage rights that are entirely open source, was it like swing left, hard left? I forget the terminology, but basically, if you've built using software that is under some kind of license, and you're going to have to pay for that in order for the app to be sold, you'll run into a problem really quickly. So VCs who do this kind of diligence want to see those usage rights, and they want to see what the stack looks like. Basically, soup to nuts, everything that the software is built on. Similarly for hardware, but less so. And then proof of assignments of the IP to the company, or a master licensing agreement if you're a university tech transfer company. So customers, this is one that can be kind of challenging because it's kind of sensitive, right? You're an early stage company. You might have a couple of customers. You might be on sort of, shaky ground with those customers just because they haven't been customers that long. It takes time to develop a customer relationship. And a customer reference call can be, it's putting your customer on the spot. It's asking them to take time out of their day. So any investor who is, frankly good at their job understands this. So I certainly appreciate that it's not an easy thing to get a customer on the phone. I certainly don't want to do anything to jeopardize a customer relationship. So we try to be really sensitive to how much of these we do. There are other investors who will sort of blindly pick customers and just say, I want this customer and I want this customer, right? Like they will pick for you. Most funds, myself included, I will ask for a reference customer. I'll let the founder do that decision making, because you don't prep all your customers to do reference calls, right? You'll prep maybe a couple. You do want to prep them. You want to tell them you're going to be reached out for a contact. And actually, I'll go into this in a second. But before that, any LOIs, partnership agreements, pricing models, any promotional material, all that goes in your folder, as well as customer contracts. So anything signed showing recurring revenue from a customer, any signed deals, all of that goes in there. So to get back to customers, my suggestion is to have a couple of references available. So if you have multiple different kinds of customers, maybe one of each. If you have like a sort of small, medium, and large offering, one of each. They might not all be contacted, but they might be. If you have multiple VCs doing customer diligence, you can consolidate that and you can do like one customer call. I've seen this. I'm usually perfectly fine with it. I'm usually perfectly fine being on the call with other investors. I get to hear their questions too. Frankly, it makes my job easier. I get to hear what other people think. And the kinds of questions they ask, which I might not have thought to ask. And you should not sit on the call. So this is something you're going to have to take on faith that your customer is going to do a good job explaining what it is, that you do for them, the value you create for them. What you can certainly do is prep them for the call. You can tell them, okay, you're probably going to get asked like these 10 questions. And there are standard questions like, how long have you been working with us? What are we like to work with as a team? Do you like the product? Is this solving a big problem for you? Here's the problem that you're solving. Talk about the scale of the problem, right? You can definitely do this. And a lot of customers will be really, if you've got customers that are happy and that like the product and that want to do this for you, they will be your advocates. Your customers will be your best advocate. I got to tell you, like the best investments, the investments I felt the best about are the ones where I do a customer call and I get off the phone and I think, this is amazing. Like this customer loves this company. And, I couldn't rip this product from their cold dead hands. That's what you want. You want that level of devotion. You want people to be screaming your praises. It's hard to get that, but frankly, that's very important for a VC's diligence. It's something that most investors do. And frankly, I think it can really tip the scales in your advantage if you've got customers that are willing to be advocates for you, who are willing to do this, and who are good at it. It's okay to prep them, and it's okay to start thinking about that as soon as you get a customer. Like as soon as you get a customer, before you do a fundraise, start cultivating them. Start getting them aware of the fact that you might someday want to use them as a reference. Maybe that's a reference to other customers or as an investor reference. But that's not something you can start too early. It really does help to have that in your back pocket so that when you get to this point, you're not scrambling to try to figure out who it is you should let the investor contact. Advisors. So advisor board folder shows your advisor's equity investing advising agreements. I do recommend having advising agreements with your advisors. Also recommend having formal equity sharing agreements and vesting schedules. I like to speak with advisors. I want to understand their relationship with the company and their level of involvement. I'll tell you a story. I was diligencing a company many years ago, like 6 years ago. On their advisory board slide, they had like 6 or 7 leaders in the market, like very impressive advisors. I called one of them. She didn't know the name of the company. That did not reflect well on the company. So prep your advisors. Make sure your advisors are committed and bought in, but prepare them for diligence calls. And again, your advisors can be great advocates for you as long as you prepare them and as long as you set yourself up for success. Okay, product overview of the product. Any kind of information you've got on the product. So that's collateral, explainers, videos, maybe schematics, design, prototyping, etc. Also, a product roadmap and a development timeline. Frankly, that's something that your investors are going to want to know in detail. So to the extent to which you can share that, the better. They're not going to expect that this thing is fully baked if it's a seed stage company. They're going to expect that it's an MVP and that you've got some early adopters. But what they want to see is where it's going. So as much documentation as you have to that, I think, frankly, I find it helpful. And I think that the entrepreneurs who provide that, again, you're showing transparency. You're showing them where the product's going and what they can expect in the next couple of years. Also, an important use of funds, right? So the development timeline, how that's accelerated with the fundraise, very important question to be able to answer. If you have deep technology, so something that is, in a university lab, whether that's batteries, medical devices, whatever, bench testing data. So for batteries, right, like one of the things we always look at for any battery company is number of cycles, charge life, et cetera. Want to see that data. Any results, anything published that you've got, that can be very, very helpful. This can include scientific journal publications, right? If you're talking about the underlying technology and what you've published around it, certainly would include that. And again, if you've done any kind of, if you've got any clinical data, clinical trials, et cetera, you want to be able to show high-level results. If they want, deep, detailed analysis, I think generally speaking, anything that you're comfortable sharing with your existing board members, you should be comfortable sharing with an investor who's coming in from the outside, because they are going to be a board member potentially. Okay, consulting agreements, services agreements, manufacturing agreements, any subcontracts you've got, and like I mentioned before, technology licenses, all of that is there. Pretty straightforward. This one's a little bit interesting. So one of the things that an investor will really try to understand is the market opportunity. And this is something you can help them with. You might think they understand the market, but they might not. And there's nothing wrong with you helping them along to sort of fully flesh out what the customer problem is, what the scale of that customer problem is. So if you've got calculations on the market size, like if you've done, any kind of modeling to show, the adoption curve, the price of the product next to how many customers you think there are of a certain type in a certain market with these specific, requirements met, that could be really helpful. It also shows you're being very thoughtful about how you're going to market and how you're sizing the market opportunity. And then under here as well, competitive analysis. So if you've commissioned any kind of competitive analysis, or if you've just done your own, or if you just show what competitors you're up against and more of like a detailed look at how your product differentiates, that's something an investor is going to do anyway by themselves. You make their life easier, but also you kind of control the narrative if you're doing that part of that work for them. I'm not gonna spend a whole lot of time on this. If you don't have business insurance, get it. If you have board members, get directors and operators insurance. You do need it. All right, let's talk about strategies for success. So I've kind of said this before, but I'll say it again. Be prepared. Have everything fully assembled in your data room. Be ready to send it as soon as an investor asks for it. Not a week from now. If I ask for it at 9 a.m., I would like the data room by 9:05. Timeliness, very, very important. keep close tabs on your communications with the investor. If they ask for something, give it to them right away. Try not to delay as much as possible. It's totally fine if it's like the close of the quarter. It's like, okay, we don't have the financials in for this last quarter. I'll get them as soon as possible, and I'll upload them to the data room within the next couple of days, and I will let you know when they're there, right? Everybody gets that. That's fine. But if I'm asking for something like an employment agreement for a certain employee or a co-founder or a vesting schedule, whatever, if it's not already in the data room, then right away be responsive. And also be patient. So you're going to fulfill requests as you receive them. You're going to be prepared for follow-up meetings or emails to answer questions about what is in the data room, where it is, more clarity on this, more detail on that. And like I said, use a data room service that shows when documents are opened or accessed. Okay, so this is from an investor who's evaluated entrepreneurs, who's done diligence cycles. I've got a couple of yellow flags and red flags that I always look out for. So here are the yellow flags. So not having a data room set up. Yeah, it's not good to have to sort of build that on the fly. Any company that I'm confident is going to raise capital will know that they've got a data room and they're going to have one set up. So that's kind of a yellow flag for me. And it also means we push out the timeline because if there's no data room, I can't look at it. Requiring an NDA. This does vary by industry. In biotech, it's more common to be under like CDA, like a confidential disclosure agreement. Most VCs don't do NDAs. If you're not willing to show the data room without an NDA, most investors will just walk. It's not standard in the market, and it's something that VCs just frankly don't want to bother with, and it's complicated. So they tend not to do it. So if you request an NDA for like a review of the data room, you're probably going to get, if you absolutely require it, you're just going to have to spend a lot more time trying to find an investor who will go for it. Being slow or unresponsive, again, this can be really problematic. If I'm waiting a week between data room requests, a week for documents, basically like just going dark for long periods, that can just raise suspicions. It makes me a little bit uncomfortable. Most entrepreneurs are very, very diligent in response. Even if you don't have something, it's okay to respond and say, you know what, we don't have that right now. I'm going to get it as soon as possible, right? Just keeping the lines of communication open, very, very important. Needing to update documents once the process is underway, like I said, getting the balance sheet and the income statement of cash flows to all sync, right? Having to do that on the fly, bit of a yellow flag. Contradictory documentation. If you have projections on one part of your data room showing that you're going to have 100 million in revenue by year 5, and another part of the data room you have 5 million in revenue, right? Contradictions like that can be problematic. And then it's just sparsely populated folders. So if there are key documents that are sort of standard that I expect, like a cap table, et cetera, missing, bit of a yellow flag. Here are the red flags, though. Pushing back on a diligence ask. So why do you need that? Why do you need employment agreements for our 1099s? I need it because I need it, because I think I need it. It might sound unreasonable, but there are very few instances, I would say, where you can actually legitimately push back on a diligence ask. If it's like you're under a confidential disclosure agreement with a vendor and you just can't say the name of the vendor, right? Like maybe there's ways we could work through that, but otherwise, you really don't want to push back on something as simple as a diligence ask. Seeking to hurry it up. When are we going to close? Why haven't we closed yet? How much longer does the cycle take? Here's the tension. Diligence can be lengthy, and you might be under a no-shop, meaning you're locked in. You can't talk to other investors for a given period while you're under diligence. You're also probably running out of money, right? That's just the reality of being a startup. So because these things don't follow a fixed timeline, this can make for a very tense process, and frankly, it can make founders sweat. I agree, it's not a good thing, but it's not advisable to hurry the quarterback. If you try to speed things up, you signal desperation. If you're trying to rush through a process, your investor will think you're either desperate or worried that you'll find something that you don't want us to, or both, right? So asking to close, expressing frustration, etc., all of that has the opposite of the intended effect. So how can you move things along? Well, the only thing better than leverage is more leverage. And what is leverage as a startup? It's time. So a healthy reserve of capital to help you float the diligence period. Don't start diligence with a VC if you have 30 days of runway left. It will not end well. a bridge plan with your existing investors. So telling all your existing investors, we're going into diligence. This might take 2 to 4 months. If it runs long, or if we need to start the cycle over with somebody else, can we rely on you for a bridge? It's an uncapped note, super simple, just giving us a little bit of runway to get through diligence, right? You should have a plan in effect that you don't need to use so that you can get through the process if it runs long. And genuine interest from other funds. If you've got more irons in the fire, you don't need to rely on one VC to make this all work. But here's what I will say. Don't say you're in diligence with other funds if you aren't, because this is a small world. And the first thing I do if a founder tells me that is I call up the VC and ask. That is a total credibility killer. If the fund says, yeah, we talked to them, but that was months ago, we don't know where they're at, that is a credibility killer. If you say you're in diligence, it really does mean that a VC is poking around your data room, they're making diligence requests, they're doing customer calls. That is what diligence means. If you're just talking to other VCs, you're talking to other VCs, which is fine, but trying to generate FOMO artificially it never works. So here's the way to avoid this. And I'm almost at the end, so I'm gonna try to take some questions. I can stay on after one if anybody wants to stay on and ask questions. Here's what you can do to avoid this tension. Start building relationships early, like early, a year before you need to raise money. It's never too early to start talking to an investor and telling them what you're doing. Sometimes it's hard to get investors to take that conversation, but frankly, I prefer talking to entrepreneurs when they're not raising money. There's less tension, it's less challenging. You're just having a conversation about what they're building, and they're starting to develop a relationship with you for the future. I prefer that because again, these are long-term relationships. It's better to have developed a relationship over a period of months than it is to just be bounced into a short game and try to get comfortable with a team, a value proposition, a technology area within 30 days, right? It's much more preferable to have the former. Prepare for a cycle, right? So prepare for this to last anywhere from 1 to 4 months. Keep your data room updated. Make sure that you've got a healthy amount of cash on hand so that you can ride out the cycle, however long it might be, and have irons in the fire. Here's the last thing I'll say too. Ask the investor what their process is. Because if you have a rough sense for what the process is, you can better understand where you are in that process. It's very hard to ask an investor, okay, so you've done this, but how much more do you have? Like, how much more do we need to do? Most investors will struggle to tell you that because really, sometimes this is just a matter of getting comfortable, and that takes time. It might take a number of cycles. But if you know what their process is, you can know when you're stalled out, and you can know when it might be time to just cut bait. And you can go back and you can say, look, you've asked for 7 or 8 customer conversations. We're happy to do these, but is this moving things forward? Like, is there anything else you really want to know? And it's fine at a point to walk away. Like if the diligence becomes abusive or invasive, or you just don't think that the investor has your best intentions at heart, then you can walk. Like there's nothing to say that you can't walk away from a diligence process. But in order to do that, you have to have a BATNA, you have to have alternatives, which is why it helps to have irons in the fire. I know I went a little bit quickly at the end there, but like I said, I don't have anything right now, so I'm happy to stick around and take questions.
Thank you so much. This has been absolutely fantastic, really useful information. And like I said, there's a lot of information out there on how to pitch, but this process is quite mysterious. So thank you so much for demystifying it for us. Any questions? So there's one there. What about debt load? If that
yes, yeah. So I think Dawn asked that question. So Dawn, do you want to like ask your question, or did you have any any color you wanted to add to that? So if not, so I'll just sort of take a stab at it then. So oh, sorry, Dawn, were you going to ask a question? So let me try answering it. So when I say debt load, what does that mean as far as like a red flag? So if you have like private debt, so whether that's like a founder's loan or debt that's not convertible, so like a loan to either like a friend or family member or a bank loan. In like sort of a more rare case, it's startups usually don't have bank loans because there's not much collateral. But that debt is what you call preferenced over an investor's investment, which is usually equity or convertible debt. So if you have a bank loan and the company gets sold, the bank gets paid first. So your investor gets paid second, which means that I want to know how much debt the company has in order to make sure that it's not at risk. I'll give you an example. I made an investment years ago. Actually, we didn't make the investment. We were looking at a company, and we were going to invest as part of like a $600,000 ish round. The company had $600,000 in debt, and so it was a $1.2 million round. But we realized really quickly that that debt was callable anytime. So the person doing the loan could just ask for the money back, and there was nothing that shareholders could do about it. So it was preference debt. When we found that out, we asked the founders, like, will you convert this debt? Like, will you make it convertible? Will you put it on the same terms as all your other investors to sort of de-risk that? And they couldn't, because the person doing the loan didn't want to. And so we walked away because it's just a risk for an investor. It's a risk to have money sitting ahead of you that can be called at any time, right? If most startups don't have $600,000 just lying around. That's why they raise money. So if I can claw that back at any time, the company goes away. And that's a massive risk as an early stage company to have. So it's okay to have a little bit of debt, like a founder's loan or something like that. It's best to disclose it. I mean, you have to disclose it, but it's best to disclose it. And what you can do is restructure it so that it becomes payable after your investors. Because the last thing an investor wants to do is cut you a check for $500,000. And the first $300,000 of that goes to pay off either yourself, if it's the founder, or another debt holder. Like, I'm giving you the money to grow the company. I'm giving you money to invest in the company, not to pay off existing debt. So that is why we look at debt load. It's why we care about debt, and it's why it really does matter as a founder to understand what your debt exposure is, and sort of how to negotiate it with an investor if it comes to it. So
and I think Dawn also. Yeah, Dawn provided also additional feedback. So she's also asking about how does personal founder debt, does it have any effect on?
Yeah, it's not uncommon. I don't know about like a HELOC or credit cards. I mean, certainly like most founders have credit debt. So the debt, if it's the debt that's owned by the founder, that's one thing. If it's owned by the company, that's another. And really it's an order of magnitude thing. So, like if it's $30,000 to $50,000, probably not a huge deal. Again, it kind of depends on the investor. Like if you're raising $1.5 million and it's like 30 to 50 grand, as long as that debt won't be immediately repaid, then it's probably not that big of a deal. What becomes a challenge is, like I said, if you're raising $1 million and you're going to be using like 200 to 300,000 of that to furnish debt that the company already has, that's not enabling the company to grow. It's just paying off a liability, and your investors are giving you money to grow. So again, restructuring some of that debt is always a possibility. One thing I see pretty frequently is the investors will just have in the either in the debt agreement or in the investment docs that the existing debt is either converted or convertible, or it sits behind the, in the event of a payout, it sits behind the equity investors.
Yeah, thank you. There's one question here if you have a few more minutes.
I do. Yeah.
What's the rough success rate of getting through diligence overall?
That's a good question. It's impossible to say. Like I said at the start, most investors don't want to enter diligence unless they're pretty sure that they like an opportunity. So the way I often describe it is, diligence is in some ways a way of thinking, is there something I'm missing here? Like, is there something that's wrong that I didn't see already? So it's almost like looking for reasons not to invest. The challenge with that question is just that it really depends. I think that in my experience, it's probably like, it's probably like 60, 70% success rate, I would think. It's not common that I uncover like a major issue in the sort of weeks leading up to a closing. It's certainly happened, but I think it also varies. It kind of depends on how quickly the investor enters into diligence. So let me give you an example. Like if you talk to a fund and you have like one conversation with an associate or a principal, and they say, okay, give us your data room. You're not on the transom of getting a check, right? Like that's probably the start of a long process. some funds want to see the data room immediately, and they want to spend a lot of time evaluating everything as they move forward in their own sort of cycle, like pitching you to their investment committee or whatever. But I also know a lot of funds that just want to take a hard look at lots of different kinds of companies. So, this is why I think having the expectation up front really helps. So like if an investor says to you, can I have your data room, access your data room? You can say, sure. What does the process look like from here? Just get a rough sense of the process. And if they say, well, we just want to learn a bit more, like, okay, so you're probably not close. So you can either give the data room or not. You could say like, well, I need a little bit more clarity. Is this sort of like, are we close to terms? Like what does this look like for you? And if they can't answer the question in a compelling way, then you're probably a ways off, and you may or may not want to move forward. It's totally up to you. If on the other hand you have 3-4 meetings, deep dives, a real sense that there's real interest, and then they get your data room, then you're a lot closer, and the success rate is probably a lot higher. Other questions, folks?
You can also raise your hand. There's a button that says raise your hand, ask your question. I can unmute your mic or just type it up. And thank you so much to Mike for sticking around extra time, and thank you for everyone who would also stay.
Don.
Yep, there you go. All right, you can speak, Don.
Hey, Don.
Hi, thanks. I had a quick question. I'm Dennis, by the way. When you're doing diligence on customers, does it make any difference whether that customer is another company or if they're consumers?
Oh yeah, that's a good question. It really depends on the company and what you're selling. Do you mind me asking like what your business is?
Yeah, so we're developing mapping software for people in wheelchairs so that they can find their way around safely. So our end users are going to be these people with disabilities who are very enthusiastic about the product, but it's a little bit different contacting consumers than it is contacting CEOs or.
Totally. Do you sell to consumers or do you get to consumers via businesses? Like, is it B2B to C?
We're going to be selling probably directly to consumers. It's going to be a mobile app that they'll use. So,
gotcha. So, I think you could do a couple things. So part of the customer diligence process for an investor is market education. Mm-hmm. So, like I said before, we might think we know about a certain problem that a customer might be having, but it really does help to hear it from the customer's perspective. Mm-hmm. There's sort of generalities or generalizations we can sort of draw from that, and if we get a sense for like roughly how the average customer is using this, feels about the problem, et cetera, then we can get a sense for whether or not and how much money people will pay for it and how big the problem is. So like that's sort of like the mindset that I enter into when I'm doing a customer call is like, how much can I extrapolate out from this? And then also like, frankly, how good is the technology from a user's perspective? Mm-hmm. So if you are selling direct to consumers, you definitely would want to have somebody who can comment on the product itself. Yeah, and I think that it is trickier than sort of the account owner of a B2B sale. Mm-hmm. I would say that you could probably get some really strong advocates if the the solution is selling. Yeah, mm-hmm. If it's solving a really big problem, you could certainly get some maybe a couple users to sort of provide their input and sort of how it's changed their lives, improved their day-to-day, et cetera. Another thing you could do though, if you guys have any sort of advisors,
we do.
Yeah, who are like experts in the technology area, in the population that you're selling to, familiar with other solutions, you could also offer that person up. It's like, well, they're not a customer, but if you want to understand the customer base, this person is a world-renowned expert on this area. Happy to set up a conversation with them to tell you about this from their perspective. So it's important to have a buyer/user weigh in for sure. But I also think, certainly for me, if I were, I'm trying to understand the market, I'm trying to understand the market opportunity, I would think that person's voice would matter a great deal as well. Mm-hmm. So, you could sort of throw that in there as like a way of getting a more like authoritative 30,000 foot view of the customer base, if that makes sense.
And I have just one follow on to that.
Sure.
So if our main customer base is people in wheelchairs, but the foundational technology that we have to build the app for them can be sold to other more like governments and
B2B type thing.
businesses, B2B type things, do we tell that to the investors? Do we describe all of the markets, or do we talk about the main one that we really started with?
So for that question, I think I would certainly join the panel that Glenn's going to do.
Okay, yeah,
And
we
I would
all
ask-
signed up.
I would ask Glenn that question. But my response is I really like hearing a founder's vision.
Okay,
So you might go to market selling hot dogs, and then you end up selling meat products to the entire world, right? It's
Exactly.
but you're going to market with one specific thing. I don't know
Yeah.
why I picked hot dogs. Maybe it's lunch and I'm hungry.
Yeah.
So the challenge is not appearing distracted as a
Right.
founder. You really have to be anchored on your go-to-market, and this is your beachhead. You're storming one beach, not a whole continent.
exactly.
But you want us to know what the continent is. So here's what things look like in year 1 to year 2.
Mhm.
After that, this technology has a much broader use case. So you can talk through like the justification for why you think governments or enterprises would be buyers for this.
Mhm.
And what you want to do is show that that's not fanciful.
Right.
So here's the market research we've done. Here are the tailwinds that we think this particular industry or this problem set is going to have.
Mhm.
And here are some early indications of interest from some of those groups.
Okay,
So even if that's like, not even like a letter of intent really, but like a letter of support, or like just somebody who matters at like a government level or an enterprise level saying like, yeah, we know this problem exists. In a couple of years, this is something we might want to try.
Yeah.
It's just a little bit of validation there, and that can be really helpful.
okay,
But absolutely, I mean, you really do want to be, especially if you're pitching a venture investor, you want to show that you're going after $1 billion opportunity.
Mhm.
And most companies don't get to $1 billion with like their first product.
Right.
It's like multiple iterations, product suite has expanded out, maybe new products. But what you're trying to show us is like what the total potential is for the market opportunity. Absolutely. The challenge is weighing that with the sort of immediate go-to-market. And
Okay.
like I said, I would ask Glenn that question. It's like what would be compelling to you? Because he's an angel investor. He looks at companies too. Like what would be compelling to you? That's less of like a diligence question. That's more something that comes up when you're doing your your conversations with the investor about like what the market opportunity is.
okay,
But you could certainly include it in your data room as far as like the research you've done to back that up.
okay. Yeah,
Excellent.
excellent. Thank you so much.
Of course, yeah. Any last questions, folks? Well, if you want to share my email, I'm happy to follow up if anybody wants to grab 30 minutes and just talk through diligence or anything else. I'm available. I'm a university employee, so it's kind of my job, and I'm always happy to do it. I love talking about this stuff. So I hope this was
thank
helpful. And feel free to contact me if you guys want to chat further or have any other questions.
Great,
Yeah,
Glenn.
thank you.
You so much. We
Of
will,
course.
we'll hit you up for a chat.
That's good.
This was
luck
incredibly
with the
helpful. Thank you, Mike. So what I'll do is if you could please send me the slides, and I'll upload the video to YouTube as soon as it's done processing. I'll follow up with everyone and send the slides, the link to the video, and I'll copy you on that email. I'll BCC everybody else, and that way people will have your email address.
Sounds great.
Thank you so much again. This has been incredibly helpful.
Thank you. Thanks so much, Ala. Thanks everybody for your time. Appreciate it.
Thanks. Bye-bye.
Bye, everybody.